Good morning, everybody, or good afternoon, sorry. My name is Kim Reynolds, and I'm here with Brett Griffiths of our Superannuation Advisory Division, and we're here today to talk you through the changes that were announced in last night's budget. Just as an introduction, Scott Morrison, for those of us that actually sat through the budget speech last night, Scott Morrison delivered his first budget speech, but it is the government's third budget since they gained power from Labor a few years ago. Morrison made a comment last night that he made a point of saying that this budget was just not a normal budget, but it was an economic plan for the transition of the economy from the mining-dependent economy to a more diversified base. So it's something that when we look at the scope of things that have changed, it has a more broad approach, I guess, than some of the specifically targeted measures that we've seen in the past. And the government's attempt to develop this economic plan has been done, it seems, in using three prongs. One is an introduction of what they've referred to as a 10-year enterprise tax plan, and we'll see how some of those, some of the stages of that have been implemented or introduced so far. Looks at fixing some of the problems in the tax system, given the tax legislation is what it is and it's quite old and convoluted. There are always going to be problems in there, and it's a matter of fixing up those as best they can rather than starting from scratch, which is a very hard task. And the third way is to try to ensure that the government lives within its means. Famous last words, I guess, but given the debt and deficit situation that we've got, but you can see with some of the things that have been announced that there are steps towards that approach. So to start off, I'm going to be talking about some of the taxation announcements, and then Brett is going to talk about some of the superannuation changes that were announced. Given the extent of some of the super changes that were announced last night, I think that Brett's going to be doing most of the talking. So I'll push on through the tax things, and some of the super stuff will actually probably take the majority of this session. So the tax announcements basically centred around these 6 areas that I referred to on this slide: multinational profit shifting and international tax issues, issues impacting on businesses, both small businesses and other enterprises, a little bit in relation to individuals and families, GST, the tax administration side of things, and some other various smaller things, well, minor items that were mentioned last night. So first thing I'll mention is, I guess, the multinational profit shifting and international side of things. Now, following on from last year's budget and also the ongoing international scrutiny of the tax paid by multinationals, this year's budget has introduced some new measures to collect tax from multinational corporations. One of those measures, and probably the most significant, is the proposed introduction of a 40% diverted profits tax, which is similar to what was introduced in the UK last year. And that profits tax will apply to multinationals that have a global revenue of $1 billion or more, and where the entity, or a particular entity within that group, is an Australian resident or has a permanent establishment in Australia. There will also be higher penalties introduced for non-compliance with Australia's tax laws, so making sure that tax returns are lodged and reporting is done as required by the tax office. And not so aimed at multinationals, but at all entities that are operating internationally. There'll be some further changes to the transfer pricing rules to put them more in line with the OECD recommendations. Now, part of that, those particular changes are centred around the valuation of intangible type assets that are used or owned by one entity in one country and used by another entity in another country, and how those assets are actually valued and what charges should be paid for the use of those those particular assets. That's one area. So those will be introduced over the next couple of years. It's just a matter of the finer details, I guess. The devil's always in the detail. But as you can see, all of these measures are basically there to ensure that companies fulfil their tax obligations in Australia. And as Scott Morrison said last night and has said in the past, that they pay the correct amount of tax on their Australian earnings. Now, one of the other aspects of the taxation changes were changes to taxation rates and the treatment of businesses. This is all part of the 10-year enterprise tax plan. These really centre around some changes to tax rates for small and medium businesses, the eventual reduction in the company tax rate, some changes to the Division 7A rules that impact on loans, payments and debts that are forgiven in relation to where there are companies within a group, and also some tax incentives for early stage investors. So the business changes that are aimed at small business and other enterprises, but in particular the small businesses we'll look at first. The government talks a lot, and I guess we do as advisors talk a lot about small businesses, but for tax purposes a small business has had a particular definition, and that definition has been an entity that essentially has a turnover of less than $2 million, that entity and entities associated with it. However, last night the government referred to the $2 million threshold for small business being increased to $10 million from the 1st of July this year, so in a couple of months' time. They also referred to changes that were going to impact on unincorporated small businesses. So they're, for example, sole traders or individual partners that are in a partnership where they have a turnover of less than $5 million. So if you are a small business, then you may fall into some of these categories but not others, and there will be particular concessions afforded to you depending on which threshold is applied to your small business. So looking at the first one, and probably the one that's going to have the widest impact, the $10 million threshold, which will apply from the 1st of July this year, increases the threshold from 2 million to 10 million aggregated turnover, and it will allow access to income tax concessions, for example, the simplified depreciation rules, and that includes the $20,000 immediate write-off for certain assets, noting that that immediate write-off really only applies until the 30th of June next year. The simplified trading stock rules, the ability to account for GST on a cash basis. There are simplified methods for paying PAYG instalments. There are also some FBT exemptions available, and also an immediate deduction for some professional expenses that are commonly referred to as, or some of them fall into the black hole of expenses that we can only get a deduction for them over a period of time. So that's where that 10 mil threshold will kick in, and as you can see, it can have some quite wide-ranging implications for small business. The $5 million threshold is probably going to have less application for the majority of clients, but if we've got a client that's a sole trader or individuals in partnership that they haven't structured into an entity at this point in time, then last year the government introduced a discount on the amount of tax that those enterprises would pay based on their turnover. So in the current year, if the turnover threshold, if the turnover is less than $2 million, then they'll have a discount on the tax that they pay of 5%. And that's capped to a maximum of $1,000. In the 16-17 year and up to 23-24, that discount rate is to be increased to 8%, and the turnover threshold will be increased to 5 million. And then you can see from the slide, in the years after that, the discount rate increases, but the turnover threshold doesn't, and neither does the cap. So as you can see, that there will be some, unless the cap moves, in future. There may be some people will look at it to see what sort of benefit there really is for this particular discount. It's all very well for the discount rate to get up, but it's a lot easier to get to it if the cap if the cap doesn't increase as well. So I guess we'll wait and see whether that's how that actually plays out over time. Now the 2 mil threshold that didn't change was where the entity might want to get access to the small business capital gains tax concessions. So these apply where an entity might want to dispose of an asset. It's subject to capital gains tax, and if it's a business or being used in a business, then there are certain conditions that have to be satisfied in order to get access to concessions such as the retirement exemption or the active asset discount, etc. So this turnover threshold is still stuck at $2 million. Alternatively, the $6 million net asset test threshold may apply. So unfortunately that one didn't increase like the others. Now the company tax rate changes also are also part of the 10-year enterprise tax plan, and as can be seen from the slide here, the period of time over which they're proposed is quite a long period of time. There's a mixture of changes in turnover to be eligible and changes in rate over this period of time. So we can see here, if you have a turnover threshold of less than $2 million in the current year, then the company tax rate is 28.5%. From the 1st of July 16, the turnover threshold increases to $10 million and the company tax rate will reduce a further 1% to 27.5%. From there on down to 2021, you can see that the turnover thresholds gradually increase up to, in 2021, to 250 million. Then after that, it continues until 2023 when the threshold is $1 billion, where you pay 27.5%. And from the 23-24 year, applicable to all companies, they will have a reduction in tax rate over the next 4 years from 27.5% down to 25%. Now, obviously, these are announcements by the government, not only just announcements, but announcements by a government that's going into an election. So, and this is a 10-year plan. All of these things are subject to how politics play out too, unfortunately. So, it'll be a little bit of a wait and see to see how this all plays out, and also how the Labor Party actually sees these changes as well. Just a point to note for those that are looking at, those accountants out there, that it will impact on franking accounts for the company also. So all those that remember when we've gone through company tax changes in the past where we've had to change franking account balances, then yeah, we'll get to enjoy that again too. Division 7A, as I mentioned before, those that have companies are likely to know all about Division 7A because it impacts on loans that they make from their company or payments that are made by the company, etc. These rules are particularly difficult and complex to apply and to administer just on a day-to-day basis. The government has been in consultation for a few years now in relation to how to make these rules simpler, and the Board of Taxation made a recommendation in 2015 as to how these rules could be simplified, and some of those changes, the majority of those changes, will be legislated or introduced for legislation, and the changes will commence on the 1st of July 2018. Now, the last item in relation to businesses is in respect of early stage investors. As we've seen, that this government has a particular innovation plan, and this early stage investor side of things is part of that. Last year, the government announced tax incentives to promote investment in these early stage innovative companies, and it was done by way of a 20% non-refundable tax offset. It was capped at $200,000 per investor per year, and also some capital gains tax exemptions where the investments were held between 3 and 10 years. As a consequence of further consultation since these announcements were initially made, the government's proposing to make further changes to these rules, reducing the holding period from 3 years down to 12 months, also placing a time limit on when the incorporation of the entity may have occurred, and also applying a criteria for what is an innovation company. The investors themselves can't be affiliated with the company, so they essentially have to be third parties that invest. And also place a limit on the investment that's made by non-sophisticated investors that qualify for the tax offset to $50,000 rather than the $200,000. So those changes are supposed to apply from the 1st of July 16. Now, in relation to goods and services tax, the good old GST that we all know and love and impacts on us every day, there's been a lot of talk in recent times about the Netflix tax and the importation of goods from overseas where no GST might be applied because they're under the $1,000 threshold. GST on low-value goods that are imported by consumers will be subject to GST from the 1st of July 2017, and there will be no limit on value. So from $0, there will be GST applied. Overseas suppliers are going to be required to register where their turnover is greater than $75,000, which is the same for people that, operating in the GST system here. So both of those aspects, bring it in line with, and I guess bow to the retail pressure that has been raised in recent times by domestic retailers that were being treated unfairly by having this competition from overseas that didn't have to pay the GST. So those changes are coming. For those of you that do have Netflix accounts, you'll see an increase in your annual subscription or your monthly subscriptions. As part of the small and medium enterprise side of things, and those small businesses that have a turnover of $10 million, less than $10 million, a simplified GST reporting scheme is going to be introduced from the 1st of July 17, and there will be a trial from the 1st of July 16, so that it isn't quite so complicated to report the different types of income to which GST may apply. So that will happen in 17. And also for those of you that might work in the space where digital currencies are starting to impact, the most commonly known being Bitcoin, there's a technical GST issue where there is a double taxation impact in respect of some of these digital currencies. So that there's a discussion paper that's been released recently that proposes to address that, and the intention is that legislation will be introduced. It's interesting to know that, although Bitcoin's probably the most widely known, there's probably, there's hundreds of digital currencies out there that people are using. So if you're in this space, you are being, impacted by it today. Indirect taxes, there are some changes to one equalisation tax rebate caps, an excise refund scheme has been extended to domestic distillers from the 1st of July 17, and as we've all heard, the tobacco excise is to increase by 12.5% annually for the next 4 years. Now, interestingly, for a budget that is going into an election, there wasn't a lot mentioned last night in relation to individuals or families. The main change that was announced was a change in one of the marginal tax bands, where the $80,000, the $37,000 to $80,000 tax band was being changed to $37,000 to $87,000 tax band. So there will be more people within that 32.5% tax bracket. There's no announcement made in relation to the temporary budget repair levy of 2% that's scheduled to end on the 30th of June next year. And of course the Medicare levy of 2% is also need to be considered. Other items in relation to Medicare, the annual changes that get made to the low income thresholds have been announced, and the the Medicare levy surcharge and private health insurance rebate thresholds have been paused for a further 3 years. So the last item I just wanted to talk about really was there is a young worker initiative that is supposed to provide a program for young job seekers that are finding it difficult to get their foot in the door. This is going to be a 3-stage process, and it's open for allowing SMEs to obtain some government assistance to get a young worker in the door, to give them an internship essentially, and with the possibility of future employment. So this is a stage process, as you can see there on the screen, and is supposed to start on the 1st of April next year. And lastly, there are a couple of other things that I won't go into in any real detail, but the taxation of financial arrangements is to be simplified, which is a good thing because it's a nightmarish part of the legislation. There are some amendments to the income tax consolidation regime, and also the backpacker tax, which impacts on the farming sector. Essentially, what that has proposed is that people here on a working holiday visa will be regarded as non-residents, regardless of how long they're here, and as such they're going to be subject to non-resident tax rates, which means 32.5% average tax rate on what they're earning. It seems that this is still going to proceed, and it's supposed to start on the 1st of July 16, so keep your eye on that for those that are in that sector. Okay, so now I'll pass on to Brett, and he will go through the superannuation changes.
Gee, thanks, Kim. What we saw announced last night is essentially the fourth largest change that has actually occurred to superannuation since we've actually had a superannuation system. Essentially, the first one being obviously the introduction of the Superannuation Act, then the 2006-7 budget changes, then some in-house asset changes that happened prior to '99, and now obviously what we're talking about today. And the reason why I say that is that it essentially structurally changes superannuation going forward as we know it, as well as existing arrangements that people have already entered into. What is actually, I suppose, most surprising is that not unlike the changes that happened in 2007, is that these changes essentially came out of left field. Everyone in the industry was completely blindsided by what was announced, albeit some of it was expected, but certainly some of it wasn't. So obviously it's important to note that all of these changes are obviously proposed because we haven't seen legislation as yet. However, one of the requirements, or one of the announcements, was effective from 7:30 last night. So there will be some limbo land, if I can say, in relation to that measure. So running through what they essentially announced last night. So firstly, what we're going to have is a $1.6 million cap on the amount that you can have in retirement phase in super. So it appears that the intention behind this is an aggregation of all your retirement savings accounts from 1 July 2017 is to not exceed 1.6 million. So in other words, it's not a per super fund arrangement, it's a per member arrangement, per person arrangement. Lowering of the concessional caps to 25,000. Introduction of a $500,000 lifetime non-concessional cap. Removal of the 10% test, and increase in the age in which the work test currently applies to age 75. All these things I'll go through a bit more detail in a minute. But just as a high level, this is what was announced. They'll be looking to remove the exempt current pension income deduction for people in pension phase where they are on a transition to retirement income stream. Reducing the threshold for the Div 293 tax. So at the moment that's at 300,000, where anyone earning more than $300,000 pays an extra 15% tax on their superannuation contributions. That threshold is coming down to 250,000. They're allowing an ability to roll over unused concessional caps for a 5-year period, so you can essentially catch up on gaps or interrupted work arrangements. Extending the spouse tax offset, introducing a low-income superannuation tax offset, which essentially is exactly the same thing as a low-income superannuation contribution, and removing the ability for super funds to pay anti-detriment payments. So as you can see, there's a fair bit that was announced last night. So what does it really mean? So what we've got now is we're just going to work through some of the current arrangements and then what the proposed arrangements will look like when they've been implemented, assuming that they go through as announced last night. So currently for concessional contributions, the tax rate's 15%. As you can see, that remains unchanged. However, currently, for the 2016 and 2017 financial year, that cap will be $30,000 for those under 50, and for those that are over 50, that will be $35,000. Rolling forward, that will actually drop to $25,000, and as I mentioned, there will be that catch-up provision where the any unused cap for the last 5 years can be sort of caught up or brought forward. The other thing which I think is an excellent announcement is the removal or the change of a 10% test for personal contributions and an increase in the work test, which is you have to work 40 hours and 30 consecutive days to be eligible to make superannuation contributions. So I think there are some very good announcements there, which we'll talk about in more detail in a second. Probably the biggest change out of the budget from last night is the non-concessional contributions. So currently we have $180,000 per annum non-concessional cap with the ability to bring forward 3 years' worth in one go. So $540,000, and then after 3 years it resets and you can do $540,000 again. What they are doing is they are limiting that to $500,000 lifetime cap. Now, the devil's in the detail with that one, which we'll talk about in a minute, but there's some very interesting legislation proposed around that. Earnings tax that's paid by the super fund in accumulation phase, no changes with that. So that's a nice easy one. 15% on income and contributions, or 10% on capital gains where the asset was held for more than 12 months. A change to where a super fund is in pension phase, however. So currently, where the assets are used to support a pension, the income derived by those assets is currently tax-free. So the exempt current pension income provides a deduction that essentially means that those earnings are tax-free. The proposal is that that will be removed, so super funds that are paying a transition to retirement income stream, they will actually pay tax as if it is in accumulation phase. So essentially earnings will be at 15% and capital gains will be at 10%. And what we're also seeing, as I mentioned before, is a $1.6 million transfer balance limit. Pension benefits, so those who are under 60, essentially the changes aren't really any different to what we have at the moment. Over age 60, it's tax-free. Now, one thing that's, I suppose, gained a little bit of popularity of late for around the superannuation industry is the ability to pay out lump sums, particularly from a transition to retirement income stream, as to pay out a transition to retirement income pension as a lump sum. And there's been a fair bit of sort of discussion on this point of late and it's starting to gain a little bit of popularity. And with anything in super, as soon as the noises are made, either the tax office, Treasury, or both look to dispel it if they don't really like the outcome. So essentially what's happening is they're legislating it so that the pension payments could not be treated as lump sums. Now, the way I read it is that this is more broadly than just the transition to retirement income stream provisions. It also applies to account-based pensions. So that's how I understand it, although there's some commentary around from sort of other commentators that aren't really looking at that. But certainly from what I've seen in the budget papers, I think it's going to be a carte blanche for any pension payment to be treated as a lump sum. So getting down to the detail. So essentially we're going to work through these in the same order as what I just ran through there. So basically, as I mentioned before, nearly all of these arrangements commenced from 1 July 2017. So we'll get a little bit repetitive on that, but it's an important point to note. So the pension account caps, they will be indexed at $100,000 increments in line with CPI, so the Consumer Price Index. Now this cap is $1.6 million. So as at 1 July 2017, the pension account essentially has to start with $1.6 million in it. If you have more than that in the pension account, or is at the moment, then it goes to it needs to be an accumulation phase. So anything that is in accumulation phase means that it's taxed at 15% or 10% for capital gains. And they've introduced a proportional method to be used where the previous unutilised cap can be used up. So I've just got a little example there. So essentially there's a mechanism whereby you can calculate where you're up to. Now, as I mentioned, this is essentially a setting of your pensions from 1 July 2017. So any subsequent fluctuations due to growth, pension withdrawals, things like that, they don't worry about those. It's only on the pension purchase price that these announcements relate to. Those who are already in pension phase at 1 July 2017, they have a choice. They either need to transfer their balance in excess of this 1.6 million to accumulation, or they can withdraw it from super. If they don't do either of those two things, so in other words, if their pension account was $1.8 million, then what will essentially happen is the government will look to tax any amount in excess of that 1.6 million. So in this example, $200,000, they will tax that at 15%. So that's essentially capital that you'll be losing, and then the earnings on that excess amount will also be taxed at 15%, as if you had an accumulation phase. Now, that's obviously an important thing to note. So you might as well, if you have more than 1.6 million in super, then it means that you might as well split it out so you're starting with that as a basis point. So it still means that the earnings on the non-pension account, so that earnings in the accumulation in excess of that 1.6 million, they're still in a very concessionally taxed environment of 15%. Now, there is some commentary around how they handle things like complying pensions. So there's a different mechanism for complying pensions because they're a non-commutable pension. I've got clients that started those arrangements back in 2004, and you can't actually change that. You can't convert that to a lump sum. What I actually haven't been able to find at this stage is any commentary on what happens to another type of pension called a market-linked pension. Now, these type of pensions are also a non-commutable, which means that you can't commute them to a lump sum. Therefore, you can't change them, you can't commute them, you can't convert some of that balance to accumulation. I don't know how that is going to work yet. The government, in their announcement last night, have said that they will be consulting with industry on this measure. So I'm presuming that that will be one of the things that will be high on the agenda as to what that means. So who knows whether that might mean some planning opportunities or whether it might actually mean that they'll come up with a mechanism whereby you're allowed to commute some of that to accumulation for these purposes. So there's still a lot more detail to come through for that. So the long and the short is that what they're trying to achieve is that anyone with more than $1.6 million in super will pay tax on those earnings. So that means that if you have 1.6 million deriving 5% income, that's $80,000 to the taxpayer tax-free. Anything more than that, they'll pay tax at 15% on. Then it will be up to the individual as to how they deal with that money in accumulation. Do you take it out as a lump sum? Do you leave it in there? All sorts of different scenarios and permutations will eventually flow depending on the individual circumstances. Concessional caps. This one was very much expected, and in fact, it's probably slightly better than what we were expecting. $20,000 was strongly rumoured to be the result. So from 1 July 2017, once again, the concessional caps will reduce to 25,000, and these will be indexed to a WATI, which is the average weekly ordinary time earnings. So as you can see, we already now have different indexation rates for the two measures that were announced last night. So existing processes for the administration of excess contributions will remain. So in other words, if you exceed your concessional cap, the tax office will basically notify you, issue a notice of assessments, amended notice of assessments, things like that. So that mechanism will still apply. Lifetime non-concessional cap. So this is the only measure that was announced last night that applied from last night, from budget night. Albeit, we haven't seen any legislation in this about this as yet. So given the fact that it's highly likely Malcolm Turnbull will be calling a double dissolution election on Friday, if not earlier, then basically Parliament will rise and this measure will need to be introduced into, as far as legislation goes, by a new government. So if that is a Liberal government, then presumably, or coalition government, presumably they will look to introduce this, and the legislation will apply retrospectively to this time. If it is a Labor government that's elected, then presumably we're now caught in a limbo for the next 6 weeks, where people inside superannuation had an opportunity to put money in, and perhaps were limited because they weren't otherwise able to. The biggest kick in the tail with this measure is that it's retrospective. It's going all the way back to 2007. So any non-concessional contributions made between 1 July 2007 and today, essentially, are caught by this lifetime cap. If you've already exceeded that $500,000, look, that's fine. No implications with that whatsoever. However, it will impact on what you can put into super going forward. So if you put in $200,000 up until today, you're able to put in another $300,000. If you've put in $1 million up until today, then essentially you're shut out of the system. This measure will increase in line with a WATI in $50,000 increments. So there is a mechanism for a slow increase on that. And as I mentioned, that after the commencement, if an individual, if you have exceeded your cap, what the commentary from the ATO is indicating is that the ATO will notify the taxpayer or the member of the fund that they've exceeded their excess contribution amount, and they need to basically withdraw that. If it's not withdrawn, then basically it'll be subject to the current penalty arrangements. So in other words, it can be treated as part of your assessable income and have implications associated with that. So it sounds like they're going to try and introduce a two-layer or two-tier effect for this measure. I don't know how long that will last, whether that will be a permanent arrangement or whether it will be a transitional thing. What I don't actually believe the government has duly considered with this measure is that while they're saying the ATO's records for non-concessional contributions are are accurate going back to 2007, the challenge is that as advisors, we won't necessarily know what that is. So if, for argument's sake, a client contributes to a colonial first state super fund, then rolls that to a self-managed super fund with another accountant, and then they come to us and we look after them for them. We won't actually know what they've made into super as that currently works. So that means that as the advisor for the client, we'll need to contact the tax office and find that out. Currently, the only mechanism to do that is via the phone. So the tax office are going to absolutely drown in telephone calls until they set up a mechanism via their online portal that's available for tax agents. But even then, if, for argument's sake, we look after the super fund and the client has someone else look after their personal tax affairs, because we have a number of clients that have that type of arrangement, we won't be able to find out the individual non-concessional caps because we're not the individual tax agent. So there's all sorts of permutations that are going to, and complexities that are going to flow from this particular initiative or announcement that I don't really think they've thought about from a practical point of view, which shouldn't come as a surprise. After all, they're sort of politicians. They live in a little bubble and don't understand how the systems actually work at a practical level.
Just quickly, Brett, one of the ways that they might deal with it is we're experiencing more and more information coming through on the pre-fill reports for individual tax returns.
Yeah, that's true, Kim.
So if the tax office has that information, they may actually pre-fill it into a new item on the individual's tax return, so they can feed that information to us rather than us having to get it. Still have that issue where we're the tax agent for the super fund, but not for the individuals. For us to actually get that information from the super fund's perspective, but the tax office is becoming more and more digital. It's a slow process. It's a big wheel to turn. But yeah, there are a couple of mechanisms. It's just a matter of how long it might take for it to kick in for us. And you can just see with all of this that there is going to be more disclosure required, not only on superannuation fund returns, but also on the individual's income tax returns to make sure that the data matching can actually happen as accurately as possible.
Yeah, well, that's right, Kim. For those that have been around long enough with superannuation, you may actually remember that before 2006 we had a scheme called the reasonable benefit limit. So whenever a pension was commenced, we actually had to separately report the pension purchase price to the tax office so they could keep a track of that record. I actually believe that what we'll have is almost a similar system. So the more things change, the more they stay the same. Now, how that actually works, I don't know. Whether they will do it as part of a superannuation reporting mechanism, or whether it will actually be a standalone reporting mechanism like the old RBL system. I don't know. So obviously time will tell what that actually looks like. But certainly, given the fact that this measure is essentially effective from last night, and obviously advisors, being financial advisors or accountants, clients seeking information will need that detail or that information sooner rather than later. And given the fact that it takes the tax office about 8 months and costs them $2 million to add one line item to a tax return as a standard, I'd hate to think what this is actually going to cost the tax office administratively to set up and get rolling with. So, and as I said, this applies from last night. So this is a fairly big deal, and one that I think is very complex and not overly well considered, if I can say. One thing that I think is a great initiative or announcement from last night is that from 1 July 2017, all Australians will be able to claim a tax deduction for any personal superannuation contributions. So it will still count towards the concessional cap and be taxed at 15%, and it will still follow the current notice of intent to claim requirements. So what that means is that essentially if I contribute, or if my employer contributes $10,000 to super, I will have the ability to top that up from my own personal income that I receive from my employer, another $15,000, and claim that as a tax deduction in my personal tax return. So the idea here is that it essentially allows you as an individual to make your own arrangements to bring yourself up to the contribution cap without having to enter into salary sacrifice arrangements where it's very easy to get caught by your employer's pay cycle and the payroll department just generally. So I think this is a great initiative. Once again though, it won't actually impact people until 1 July 17, so in other words the 2018 financial year. Increase in the age for the work test. As I'm sure you all are well aware, superannuation is very ageist. So in other words, there are lots of age requirements in there and restrictions based around age. What this measure is essentially recognising is that people are working longer and they want the ability to put money into super. So that means that currently up until over 65, you have to meet a work test. From 1 July 17, that will increase to essentially 74. So you have to be over 75 or older to meet that work test requirement. Further spouses won't need to meet a work test. Currently that's 70. They won't need to meet that work test until they're 75 as well. So it allows a longer time period to get money into super, which I believe is certainly a good thing. Transition to retirement income changes. Now, I expected changes to these rules. I didn't quite expect it to work this way. So essentially what they're saying is that from 1 July 17, so it will affect the 2018 financial year, exempt current pension income deduction will not be available for pensioners who are on a transition to retirement income stream. To have that benefit, you will need to be on an account-based pension. To be on an account-based pension, you need to satisfy a particular type of condition of release. So not only do you have to meet your preservation age, which will range anywhere between 55 and 60, depending on when you were born. If you're between preservation age and 59, you actually have to retire with a view to permanency. Between age 60 and 64, you have to cease a gainful employment arrangement. So in other words, an arrangement for which you have been paid to work. And over 65 is an automatic condition. So that's what you need currently to meet an account-based pension. Those rules won't change, but what will change is that the transition to retirement income stream deduction, or the deduction on the earnings that those people will receive inside the super fund. So there'll need to be greater, I suppose, care and diligence in assessing whether a client has actually met those conditions to satisfy an account-based pension as opposed to the current TRIS arrangements. Because up until now, there hasn't really been a need to worry too much about that. Div 293 tax. So this is where basically there's an adjusted income amount. So that threshold is now going to be $250,000. So if your income and superannuation contributions is greater than $250,000 from 1 July 17, so once again, 2018 financial year, then the tax that those people earn on their superannuation contributions will be increased to 15%. Now that currently happens via a mechanism with the tax office, so they issue an amended notice of assessment essentially. That will still continue. All they've done here is drop the threshold by $50,000. Unused concessional caps. So this is I think a great initiative as well. So essentially, once again, from 1 July 17, if someone with a superannuation balance of less than $500,000, they're able to actually carry forward any unused concessional contribution cap for a 5-year period, and it's a rolling 5-year period. So in other words, if I were to contribute $10,000 into super this year, $10,000 into super next year, that means that I have used up essentially $20,000 of my $50,000 cap. So that means in year 3, I can put in that $30,000 differential as well as my $25,000 cap for that year and claim a tax deduction for it. So it allows the ability to essentially potentially plan for a greater tax deduction around sale of assets or things like that, on the basis that your balance is actually less than $500,000 inside super. And once again, I'm presuming that will be an individual test rather than a super fund balance test, for those who are trying to think of ways to work that system. A couple of other, I suppose, more minor announcements that were announced last night, extending the spouse tax offset. So once again, 1 July 17, the current 18% offset of $540 that's available for an individual, where they're contributing to a receipt to a spouse whose income is less than $37,000. So currently that threshold is $10,800. So they've increased the ability to get that or make access to that tax offset. And basically, the offset will gradually reduce for incomes above $37,000 and will reduce out by 40. So it's purely looking at providing a mechanism whereby those that are earning less than $37,000, their spouse is able to help their superannuation along a little bit. Low income super tax offset, a non-refundable tax offset that applies to those with an adjusted taxable income of $37,000. Basically, the ATO will look to pay their superannuation fund $500. That means that their SGC on the contributions for that $37,000 will be essentially taxed at zero. That's the way this mechanism is meant to work. So if an individual has an adjusted taxable income of less than $37,000, the super fund will receive up to $500 as a refund or a rebate to offset the tax that the super fund has paid. So once again, more looking at trying to increase those with low balances. And finally, anti-detriment payments. So currently there is a little provision there that allows the refund of a member's lifetime superannuation contribution tax to be refunded back to the super fund. Now typically this isn't something that's used by a self-managed fund because it's fairly difficult to work because the physical payment of cash needs to occur. But it's widely used by larger retail funds, but from 1 July 17, that deduction will no longer be allowed to them. So essentially, that's a small tax saving and sort of tidying up some old legislation that's been around for a long time that, to be honest, doesn't really get used that heavily. So in a nutshell, that's essentially the superannuation changes that that we saw last night. So there you go.
Okay, so just before we sign off, one of the items that we haven't put on the slides is partly because I wasn't quite sure where to put it. There's a line in the budget papers that refers to decisions taken but not yet announced, which shows increased spending in year 1 of about just under 500 million, in year 2 of about just over 600 million, and in year 3 of 500 million. And then cuts over that period, that same period, of about 1.9 billion. Means the cuts outweigh the spending. Although this budget doesn't seem to have a lot in it at this stage for an election, those decisions taken but not yet announced are supposed to be announced by the government within 10 days of the election being called. So assuming the election's called on Friday after the opposition has provided its reply speech on Thursday night, then it's likely that, you know, towards the end of next week, early the week after, we'll get some further announcements as to what the government's planning on doing with those decisions that they've made but not yet told us about. So there's still more to come. Like I said, we're about to enter into an election period as well, so things always get interesting around there. If you've got any questions about the things that Brett and I spoke about today, feel free to contact us on our emails or phone numbers. I've noticed that my name's spelt wrong on that slide, so I apologise for that. And yeah, if you've got any questions, feel free to get in touch with us, and we'll try to help you through navigating this process. Thanks very much for listening, everybody.